Hello viewer, welcome back to my channel Hocantalk.english. Today for this video, we are going to cover the topic US Treasury Market Overview. In this video, I'm going to tell you everything regarding how US government decide how much debt to issue, the issuing process, who are involved in the decision making, and the process of setting the price, the yield for the debt, and also some of the governance or compliance issue involved in all these issuance. Now, if you look at the next slide, I actually produce all the relevant department or agent within the USA government that are involved in the issuance of treasury. First, if you look at the box, which is a brown color box, I actually put down Congress. Now, actually, Congress do not involve in the day-to-day issuance of all the treasury instrument, but they actually set a debt limit. So as far as the debt limit is not being exceeded, Treasury, US Treasury is legally allowed to borrow within that ceiling. So as far as the Treasury is under this limit, it has the standing authority to issue any debt instrument. Now, the budget actually is controlled by the Congress, meaning Congress decide the spending and the tax law that create the deficit and necessitate the borrowing. So actually you can see that starting from the Congress, they approve all kind of budget and all kind of spending, and because of all this budgetary planning and spending expenditure, it created a gap in the funding, and that gap will be filled by issuing of the debt instrument, and that instrument will be all kind of treasury instrument. Now, for the president of USA, the president also does not manage the debt issuance. The president role is primarily the nominating who is the secretary for the treasury, for US Treasury, signing the budget and the debt limit legislation, and overall, including the timing of when the treasury debts are being issued, is not handled by the president himself or herself. It is overall handled by the Treasury Department to maintain market stability and independence. Now, if you look at the blue box and the green box, now we are moving on to the process of issuing debt. Now, in this case, there are actually two organizations involved within the US government. Number one will be the US Department of the Treasury, and they act as a borrower. So on all the treasury instrument, whether is it a bill, which is a short-term instrument less than 1 year, or if it is a notes, which is a medium term less than 10 years, 1 to 10 years, or the long-term one, which is called a bond, which is more than 10 years to as long as 30 years, you can see that on all these certificate, on all these treasury certificate, the issuance are, or the issuer are the US Department of the Treasury or the Treasury of USA. So they are the one that actually issue the IOU or all these instruments, and they are the borrower. So if you look at the blue box in the middle, they are the borrower in this whole issuance. And what is the role played by Federal Reserve? Federal Reserve is the agent that actually coordinate, handle all the process, the pricing, set the pricing, and all the administrative process, including buying of secondary market, buying treasury from the secondary market to implement certain monetary policy. So in short, the US Department of the Treasury make the decision how much to raise, when to raise, and these decisions are actually made by the Office of Debt Management within the US Treasury. Despite the fact that it is the Treasury or the Secretary of the Treasury who has the ultimate authority to decide how much is going to be issued and also when it will be issued, but all these decisions will only be made after discussing with the Treasury Borrowing Advisory Committee, in short called TBAC. And this committee is a group of private sector experts, people from all the banks, all the primary dealers, who provide recommendation on the issuing size, because they are the people who know how the market will react. So these people will recommend the right size of debt that could be issued within a certain time period, and the Secretary of the Treasury will make the ultimate decision. Now, the next slide will show you all the three tiers of the US Treasury debt issued by US government. If you look at the slide that I produced, the box on the lower part of the slide, which is the blue color box, are the short-term Treasury bills. When we use the word bills, it means that anything below 1 year. So we have maturity 4 weeks, 8 weeks, all the way up to 52 weeks. And all these instruments are usually issued, announced on Monday, and complete the issuance on Thursday. So if you look at the green color box, then these are the notes category. The notes are anything between 2 to 10 years. So they have 2 years, 3 years, 5 years, and 7 years kind of note, and of course, and 10 years. And of course, the last category will be the T-bond, Treasury bond, which have a maturity date of 20 and 30 years respectively. Now, actually, in addition to these three type of treasury instrument, there are two more treasury instrument which I did not put into the chart or put into the slide, but I will just mention them verbally. One would be called the Treasury Inflation Protected Securities, in short TIPS. This one has a duration or a time period of 5, 10, and 30 years. And the principal value of this instrument will be adjusted based on the consumer price index to protect against inflation. So investors who buy these TIPS, Treasury Inflation Protected Security, are people who are very mindful of the inflation and wanted the debt instrument to adjust the value according to the existing inflation trend in the market. Now, there are also another type of treasury debt issue is called the floating rate notes, which is on a 2-year time period, 2-year tenor. And the interest rate will keep resetting weekly based on the most recent 13-week T-bill auction result. So as you can see, the floating rates note are on a 2-year tenor, so they are being called the notes instead of bill. So these are the two additional instruments that I did not include in the slide, but I will mention to let you have a full picture. Now, if you look at the slide further, if you can see that the T-bills, which are the bills that issued less than a year, they carry zero coupon, meaning they don't have any coupon payment, but they are being sold at a discount, so that when you redeem, or when the US government redeem this T-bill, they will pay you in full at par value, and the difference in between will be the interest that you earn during the less than 1 year period. For treasury notes, they do pay a coupon, and the coupon is a fixed interest rate for every 6 months. Now, who decide the interest rate and all these things? Of course, I mentioned there is a panel of primary dealer, committee members, and then they will discuss and decide what should be the right interest rate that should start with. But again, the ultimate finalization of the interest rate will be based on a Dutch auction process. Likewise for the T-bills, likewise for the T-bond. So these three issuance for the T-bills, T-notes, and T-bond, the ultimate pricing decision will be decided by a Dutch auction, which I will explain later on. Now, lastly, come to the treasury bond, they also pay coupon, which will be fixed. They pay fixed interest every 6 monthly. Now, why does the treasury use a complex Dutch auction system instead of just setting a price or an interest rate after they discuss with the committee or the primary dealers for the new issuance. Now, the reason is because the market changes very fast, and if the Treasury set a fixed price, which will decide the interest rate on Monday for a Thursday issuance, when there's a sudden change in inflation data or in a market condition, that will immediately makes the price set on Monday either too high or too low, and it will result in the issuance is not being successful. So the Dutch auction ensure that the Treasury always receive the exact market clearing price at that specific moment. And I will explain the Dutch auction system in the following slide. Now, before I actually move on to discuss the Dutch auction system, I just want to show you this slide which cover some of the other debt instrument um, issued by other countries such as UK, European Union, Singapore, Japan, and other emerging market. As you can see, the rest of the other country in the world, they also have short-term instrument, and they also use different names for to call this instrument. So they are unlike USA, which call short-term treasury bill. In other country, they might use other terms. So you have to be alert if you come across any of these names which are used differently as compared to the US Treasury market. Now, the next slide, which is this slide, I actually recap what I actually discussed earlier regarding all the time period for all the issuance of treasury debt. So this gives the investor a very regular and predictable schedule, and they know when they will know when the US government is going to issue debt, and they can get themselves prepared. So from this slide, you can see that the T-bills and the T-notes and the T-bond, they have a predictable schedule. So every investor can know that on certain date, there will be some issuance of the debt instrument. But of course, they do not know what would be the size, which will be announced by the US government. Now, the Dutch auction system to decide the pricing for all the treasury instrument issued is a very unique practice in the USA, because some other country or the issuance of corporate bonds or some international sovereign bonds actually use something called the book building exercise, whereby all the banks will gather together, or all the investor, then they will give order and set a price. But for US Treasury, all the treasury, including the T-bill, the short term, T-notes, the medium term, and the T-bond, are also using the Dutch auction. Now, how does the Dutch auction work? So basically, step one, the Treasury will announce the amount they want to borrow. Then step number two, they will invite the bidding process. So investor will submit two type of bids. The first type is called the non-competitive bids. So if you can see from the chart, is on step two, the bidding period, which is the blue color box. Now, investor will agree to accept whatever rates the auction determines. So investor who put in non-competitive bids will accept whatever kind of interest decided after the auction is over. Now, there are bigger investors who would like to put in competitive bids so that they can decide, or they actually specify the lowest discount rate or the interest they are willing to accept. So these are called the competitive bids. So there are two types, non-competitive and competitive. After the Federal Reserve receive all these bids, then they will go through the determination process. The Treasury will accept all the non-competitive bids first, because these are investors who will accept who are agreeable to buy the debt instrument at whatever rates are being offered to them. After this segment is being cleared, the Federal Reserve will then work up the list of competitive bids submitted by this group of investor, starting from the lowest rate and until the entire offering is sold. And the key thing about Dutch auction is they will use a uniform price, meaning the highest rate accepted to fill the order will become will becomes the stop out rate. Every winning bidder, including those who bid at a lower rate or those who from the non-competitive bids, will receive the same final rates. The Dutch auction is used for all the treasury instrument, which means the short term, the medium term, and the long term. But the underlying interest that the investor bid at during each of the Dutch auction is quite different. Now, because for the treasury bill, they don't have any coupon. So when the investor bid in a Dutch auction for treasury bill, they actually indicate the discount rate they are willing to enjoy or willing to earn because there's no coupon payment. Now, for treasury notes and bond, there is a set coupon, meaning the treasury, the Federal Reserve, after discussing with the committee, they will set a coupon rate, meaning something close to the market interest rate. But in order to make sure that the investor receives something more aligned to the market situation, the investor in the Dutch auction will bid using an interest called the yield to maturity. So if the yield to maturity is set higher than the coupon rate decided by the Federal Reserve and Treasury on the Treasury notes or the bond, then it will be sold. If it is the yield to maturity is higher than the coupon, then the Treasury instrument will be sold at a discount. But if the yield to maturity bid by the investor is lower than the coupon, then the instrument will be sold at a premium. The next slide actually shows the end or the complete life cycle of a T treasury instrument issuance. So I have mentioned for the first three boxes, box 1, box 2, and box 3. So now I'm going to talk about the last one, which is the box on the extreme right, the green color box. Now, I just go through the procedure. So it started from an announcement. So for example, on Thursday, the Treasury announced that they're going to issue a certain debt amount, for example, 100 billion. And the bids will be start to collect electronically via the Treasury Automated Auction Processing System, in short called the TAAPS. And then on the actual auction day, which will be on a Monday, the auction will close at 11:30 for all the competitive bids. Now, the non-competitive bids will be submitted during this period as well. And the stop out rate, meaning the final rate that will be decided for ultimate pricing of the treasury instrument, will be determined within minutes once the auction closes. And on the issuance date, which is another coming Thursday, the cash is withdrawn from all the bidders' account who managed to win the bids, and the digital security are deposited into their portfolio. So the whole cycle is exactly 1 week after the initial announcement on a Thursday, and the Dutch auction is conducted on a Monday, and the issuance is on the next Thursday again. Now, the next slide, I actually summarize whatever thing I've discussed so far, because I'm quite sure there are so many beautiful graphics that I've generated. Some of you might not be able to get the full concept. So I put it in a simple table format, the summary for the treasury issuance and management. You can see from this table all the roles played by the different parties in the whole process. So I will not go through them again. You can take your time and read through all the wordings on this slide. Now, the next slide, I just want to briefly touch about what we call the US Treasury yield curve. I won't go deeper into it because that will require another video to discuss about the economics impact of different kind of yield curve. So basically, the yield curve is the interest rate a graphical illustration of the treasury instrument. So if you put all the maturity of the treasury instrument on the x-axis, meaning from short term to long term, then theoretically it should be on a green box, which is number one, a normal curve. The longer term investor will require a higher interest rate. And the shorter term, because it's a shorter duration, investor will be okay with a lower interest rate. So the second box, which is blue color, is called a steep curve. So when the economy is doing very well, very fast expansion, you can see the curve actually are the gradients of the curve is higher. But in a period whereby there's uncertainty, then you will go to the third box called the flat curve, meaning that a lot of people don't know what's going to happen. So the interest rate for the short term and the long term are almost the same. Now, the worst case will be on the fourth box, the box number 4, which is a red color, is called a inverted yield curve, meaning the short-term rate is actually higher than the long-term rate. So that means people are worried about recession. So they want to charge a higher interest for a short-term borrowing. But again, this slide is just to show you there are different kind of curve for the interest rate, and I won't go deeper into it because this require another video to explain. Now, coming to the next slide, I actually put down all the current market share and market size of the treasury instrument for 2026 up to April. So you can see the total debt level of USA is about 31 trillion so far. Again, the graphics is very straightforward. I won't go through them. You can take your time to read through. So overall, you just know that the total debt level is from all these treasury instruments is around 31 trillion. Now we are coming to the end of today's video, but I want to make my video complete by mentioning something very important, which is called the legal firewall. As mentioned, there are two government agencies involved in the US Treasury issuance and the price setting. So first, you know that US Treasury will be the issuer. These are the borrower. And then Federal Reserve will handle all the auction, the paperwork, and the settlement. But maybe someone will ask me a question. Why go through all this process? If the Treasury want to issue some debt, can the Federal Reserve just simply be the buyer and buy over the whole thing? The answer is there is a legal law. It's called the Federal Reserve Act that prohibit the Federal Reserve from buying Treasury security directly from the Department of Treasury at auction. They are not allowed to do that. They must buy them from private banks and investors in the secondary market. Who are they? Federal Reserve are not allowed to buy in the primary market. They can only allowed to buy treasury instrument in the secondary market from other investor. Now, why is this so? This is to avoid a government from printing unlimited money and resulted in hyperinflation. If there's no firewall in between the borrower and the buyer, and in this case, the borrower is the Treasury, the buyer is the Federal Reserve, then the US government can keep printing money and issue debt without any check and balance. So they have to go through a process to make sure that the Federal Reserve is not allowed to buy from the Treasury directly. So they have to go through a third party, meaning they can only implement secondary purchase, not primary purchase. Now, I can give an example to illustrate further. Now, if the Federal Reserve is allowed to directly buy from the Treasury, then basically the Federal Reserve can create 100 billion US out of thin air and deposit into the Treasury account, and this is called monetizing the debt issue. And there's no private buyer involved, and the government can keep doing so until the dollar or the underlying currency resulted in drop in value, and this will lead to hyperinflation. So you can see that thing happen in other countries, such as some of the African country. So this is the reason why there must be a firewall for in between the Treasury and the Federal Reserve. Okay, now we have come to the end of this video. I hope you like the content and benefit from this video. Do subscribe, and I will produce and I will continue to produce good video for your viewing. Thank you very much.